This is also true with federal and private student loans. If you are someone who listens to our separate Escape Student Loan Debt podcast, you know that with federal student loans, you can ask for forbearance for economic reasons for up to a year consecutively or 3 years over the course of your loan repayment. But I would also encourage you, if you're someone who pays your loans using an income-driven repayment plan, to instead of putting your student loans on forbearance, consider contacting your loan servicer and asking them to recalculate your payment. If you're in a single income household and you have no income, you can stay on an income-driven repayment plan for a federal student loan, have your payment recalculated to $0, but still receive credit towards forgiveness programs like those offered under income-driven repayment. But even if you have reduced income and you're part of a two-income household, you can still ask for them to recalculate your payment based on your reduced income and at least lower the amount while still receiving credit for that federal student loan. With private student loans, you'll also find, unlike how it worked when I first got into this industry, when they used to publicly state the rules of economic hardship forbearance, that many private student loan lenders offer these programs, they just don't publicize them. They offer in-school deferment, and typically these hardship forbearances are for a period of 3 months, and it may not exceed 12 or 18 months over the course of the loan. If you're looking on screen now, we're pulling up SoFi.com, and you'll see that that information has been hidden, but it's not gone away completely. Looking at the screen, it says, does SoFi have any deferment or forbearance options? It says, and I quote, SoFi offers our borrowers a variety of deferment and forbearance options. For a hardship forbearance due to involuntary employment, you may apply through SoFi.com. They're not going to give you the details of the program. They're not going to promise you certain information, but they are saying if you're proactive about reaching out to us, we can see if there's a program available to you, but you have to reach out to us first to let us know the situation. Now, the word of warning that I would give you for all of these circumstances is if you can avoid it, you don't want to pursue any of these programs in a way that negatively impacts your credit if you have other options available. So while you do need to be proactive in letting your lender know and asking what's available, you also want to make sure that you get details from them in writing about the impact of whatever program you might accept on your credit. You want to make sure that you have an understanding of how that information is being reported. Now, obviously, depending on the severity of your financial circumstance, it may be something where you say, hey, I need the no payment more than I need a better credit score right now. But I just want to make sure that you don't completely neglect the fact that certain lenders report these types of programs to credit bureaus differently than others. Since we just talked about credit cards, the next thing we'll talk about are balance transfer cards. Balance transfer cards, as a recap, are cards that offer you an introductory period when you open them where you can take debts that you owe on other credit cards and transfer onto the new card at a period where there's a 0% interest rate. So they'll charge you a transfer fee of say 3 or 4% to bring the funds over. And then as a part of that introductory offer, they may say for the next 12 to 18 months, you can leave it here without any interest accruing on your debt. All of these cards are giving you the opportunity when you need to have flexibility in your cash flow the most to look at a credit card debt and say, it's not that I don't want to pay this down, but I can't pay it down right now. The minimum payment is killing me, and I don't want to watch my credit card balance increase. It may be an opportunity after evaluating the pros and cons of opening another card to take that balance, move it over so that it's not growing at interest, and also reduce your minimum payment in a way that increases the flexibility of your cash flow.